Most people never think about the Strait of Hormuz, because on the surface it feels too far away, too narrow, too technical to matter in everyday life. It is not a place most Americans could point to on a map, and yet it quietly shapes the cost of gasoline, the price of airline tickets, the operating costs of factories, and the inflation that reaches grocery stores and family budgets. That is what makes it so dangerous. The world rarely notices the Strait of Hormuz when it works, but the moment it stops working, the consequences move faster than most governments, companies, or consumers are prepared to handle. At its narrowest point, the strait is only about 21 miles wide, a thin strip of water between Iran and Oman. But every day it carries roughly 20 million to 21 million barrels of oil and petroleum products, along with about 1/5 of global liquefied natural gas trade. In financial terms, that makes it one of the most valuable corridors on Earth. At $80 a barrel, the crude value moving through that passage is about $1.6 billion a day. At $100 a barrel, that rises to about $2 billion a day, and that is before including LNG cargoes, refined products, insurance costs, tanker contracts, and the countless secondary costs that filter through transportation, manufacturing, utilities, and consumer prices. For years, the global economy treated all of that as background infrastructure, as if this route were not a vulnerability, but a permanent law of nature. That illusion shattered in late February 2026, when U.S. and Israeli strikes on Iran triggered a new and more dangerous phase of escalation. Iran warned that ships attempting to pass through the Strait of Hormuz could be attacked, and that warning alone was enough to change the behavior of the market. A choke point does not need to be physically sealed to become effectively closed. It only needs to become dangerous enough that ship owners, charterers, insurers, and governments start treating it as impassable. That is exactly what happened. Within days, tanker traffic collapsed, and a route that the world had assumed would always remain open suddenly looked like a financial trap. The first cost of that collapse was the most obvious one: the crude itself. When a corridor normally handles roughly $1.6 billion to $2 billion in crude value every day, even a partial disruption means that enormous sums are immediately delayed, stranded, repriced, or forced into more expensive detours. But the deeper damage appeared in the financial plumbing surrounding the oil. Shipping risk exploded. Insurance markets reacted almost instantly. War risk premiums surged by more than 1,000% in some cases. And on a tanker worth around $250 million, a 3% hull war risk premium meant about $7.5 million for a single voyage, up from roughly $625,000 before the crisis. That is not the kind of increase a market casually absorbs. That is the kind of increase that changes decisions across the board. Cargoes get delayed, sailings get canceled, fleets hesitate, and suddenly supply that technically exists becomes supply that the market cannot confidently move. This is why the Strait of Hormuz is not merely a geopolitical story. It is a financial story in its purest form, because it reveals how quickly the price of risk can overpower the price of the commodity itself. Potential insurance losses tied to damaged vessels were already estimated at around $0.75 billion. And that figure did not even include the value of damaged cargo, delayed deliveries, refinery disruption, emergency fuel replacement, or the inflationary wave that follows once energy markets realize they are dealing with more than a temporary scare. At the same time, analysts identified an $18 per barrel geopolitical risk premium in crude, which, spread across roughly 20 million barrels a day, suggests about $360 million in additional daily market value being repriced purely because fear entered the system. Before the world was even fully short of oil, billions of dollars were already being lost, frozen, shifted, or marked higher simply because the market had been forced to take the threat seriously. What makes the situation even more dangerous is that the exposure is not distributed evenly. The strait matters not only because of how much energy moves through it, but because of where that energy is going. More than 1/4 of global seaborne oil trade passes through this choke point, and most of the LNG shipped through Hormuz heads to Asia. That means the countries most exposed are heavily import-dependent economies whose industrial systems depend on reliable fuel arriving on time and at manageable cost. Japan receives around 75% of its oil imports from the Middle East. South Korea receives about 70%. India gets about 53% of its LNG imports from Qatar and the UAE. Bangladesh about 72%. Pakistan about 99%. And China sees around 40% of its oil imports pass through Hormuz. Once traffic through the strait begins to collapse, the problem no longer belongs only to the Gulf. It belongs to Tokyo, Seoul, Mumbai, Dhaka, Islamabad, and Beijing. It belongs to utilities searching for fuel, to refineries trying to schedule crude runs, to governments trying to contain inflation, and to consumers who may never have heard of Hormuz, but will still pay for what happens there. And then there is the gas market, which in some ways may be even more vulnerable than oil. About 1/5 of global LNG trade passes through the Strait of Hormuz, and if those flows are halted for a month, benchmark gas prices could surge by as much as 130%. That kind of move is not a normal fluctuation. It is the kind of shock that can trigger emergency fuel switching, industrial shutdowns, aggressive bidding wars for replacement cargoes, and political panic in countries already operating with limited margins for error. In places that are deeply dependent on imported gas, an LNG shock can quickly become a power crisis, and a power crisis can quickly become a social and political crisis. The reason the world fears this scenario is simple. There is no clean backup plan. There are pipelines that bypass part of Hormuz, but they cannot replace the full flow. Strategic reserves can soften the blow for a while, but reserves buy time, not stability. Cargoes can sometimes be rerouted, but rerouting raises transit costs, extends delivery times, and ties up ships in a market that becomes tighter by the day. The global energy system was not built for redundancy. It was built for efficiency, and efficient systems are often at their weakest when something essential fails. That became obvious almost immediately, as Iraq was forced to halt operations in some major oil fields because it lacked the means to export without access through Hormuz. At the same time, analysts estimated that Gulf producers could handle only about 25 days of stranded supply using storage and tanker capacity before the system began to choke. That creates a hidden countdown. At first, storage absorbs the stress. Then storage fills, then exports stall, then production slows, and what started as a shipping disruption slowly turns into an actual supply disruption. Once that process begins, the losses compound with alarming speed. If severe disruption places roughly $1.4 billion to $2 billion in crude value under stress each day, then 10 days means $14 billion to $20 billion of crude flows disrupted, delayed, or trapped. A month means $42 billion to $60 billion, and that is still only the first layer of the damage. The second layer comes from the way higher energy prices spread through the wider economy. Airlines face more expensive jet fuel. Shipping lines face higher bunker costs. Trucking companies pay more for diesel. Chemical producers pay more for feedstocks. Governments spend more trying to stabilize electricity and fuel prices. Consumers absorb higher transport, heating, and food costs. Inflation begins to climb again. Markets start revising interest rate expectations, equities reprice, and recession risks become harder to dismiss. This is how a 21-mile waterway reaches balance sheets and household budgets thousands of miles away. That is why the efforts to solve the problem are so revealing. The first response has been military. President Donald Trump pushed to reopen Hormuz with U.S. Navy escorts and support measures designed to help restore tanker movements. On paper, the logic is straightforward. If private shipping companies are too afraid to move, military escorts are supposed to rebuild confidence. But confidence and safety are not the same thing. Escorts may help at the margin, yet they do not fully reopen the waterway unless the threat to passing ships is reduced to a level the market can tolerate. The second response has been financial, with Washington exploring ways to support or backstop tanker insurance, Following the old logic of the tanker war era, when keeping oil moving became a matter of state strategy rather than normal commercial calculation. The third response has been time itself. Producers leaning on storage, governments monitoring reserves, importers hunting for alternatives, and traders trying to determine whether this is a short-lived panic or the beginning of a deeper structural shock. But none of these are real solutions. They are survival strategies while the market waits to see whether the corridor can once again be trusted. And that word, trusted, may be the most important word in the entire story. The Strait of Hormuz cannot be reopened by declarations alone. It cannot be made safe by headlines. It only truly reopens when ship owners, insurers, traders, governments, and energy buyers believe the math works again, when the cost of passage, the probability of attack, and the risk of loss return to levels that the system can bear. Until then, every tanker movement, every cargo decision, and every price quote carries a Hormuz premium. Responsibility, of course, runs through the story in layers. Iran bears direct responsibility for threatening ships and transforming one of the world's most important trade arteries into an active zone of financial danger. But there is also a larger systemic responsibility that is impossible to ignore. For decades, governments, traders, oil majors, and importing nations knew exactly what Hormuz represented. They knew it carried around 1/5 of the world's petroleum liquids consumption. They knew it handled about 1/5 of global LNG trade. They knew it sat on one of the most volatile geopolitical fault lines on the planet. And still, year after year, the world kept building around it, because the route was efficient, profitable, and for a long time, just stable enough to preserve the illusion that it would always remain usable. That may be the deepest financial lesson in all of this. The global economy did not simply become dependent on the Strait of Hormuz. It made a long-term bet on it. A bet that this narrow corridor would stay open because the world needed it to stay open. A bet that military deterrence, commercial logic, and decades of routine would outweigh geography and conflict. A bet that if enough money depended on the route would somehow be protected by its own importance. March 2026 exposed how dangerous that assumption really was, because once the strait effectively closed, the bill began arriving all at once. About $1.6 billion to $2 billion a day in crude value moving through the corridor. About $7.5 million in war risk insurance for a single tanker voyage. About $0.75 billion in possible insurance losses tied to damaged vessels. About $360 million in extra daily oil market value from geopolitical risk premium alone. And tens of billions in disrupted crude flows if the crisis lasts for weeks rather than days. That is what makes the Strait of Hormuz one of the clearest financial stories in the world. It is not just a military flashpoint or a shipping route. It is a hidden toll booth on the global economy, one that most people never see until the price of passing through it suddenly explodes. When it works, the world barely notices it exists. When it breaks, everyone pays. And that is the real meaning of this crisis. A narrow strip of water that looked like background geography turned out to be one of the most expensive pressure points on Earth. A place where a single rupture could send costs racing through oil, gas, trade, inflation, policy, and growth all at once. In the end, that is the part that makes the Strait of Hormuz so frightening. It reminds the world that stability can depend on something as thin as 21 miles of water, and that once that narrow passage stops feeling safe, the entire global economy starts paying the price.